So I'm reading a question that says, "Are doc loans for doctors?" And I think what this is referring to, it's referring to something that is called either physicians loans or more recently professional mortgages. What these are for, they are for basically people who have a high degree of education that are professionals in their fields, right? So we offer these loan products. They are good for doctors, nurse practitioners, CPAs, like anything that's in that kind of scope of work. I know those are very different, different categories. It's not necessarily related to the medical field. Attorneys also would be this would apply for an attorney. These do a couple of things. Most of these careers, like these, are geared towards professionals who had a high degree of education and then usually spent a good deal of money on getting their education. So these loan products, they are geared towards these professionals. They have a couple of benefits that will help people who have maybe a high degree of student loan debt. So the first thing that these things do is they disregard student loan debt for the purposes of qualification. The rationale behind this is that most of the time, the people who are taking these loans out are at the beginning of their careers and they have a lot of upward mobility as far as income goes. So they probably are not earning as much now just getting out of school as they will be in the future. So that's pretty well understood, is that most professionals in this capacity are going to earn a lot more the later they get into their career. So they ignore student loan debt, which is great for people who are very highly educated. A medical school, can be $500,000. Somebody taking out a regular mortgage, we have to take into account that student loan debt. It counts towards your debt to income ratio, even if you're not making monthly payments on it. Like it might be deferred. We still have to take 0.5% of that total student loan balance. So if you have a $500,000 student loan balance from going to medical school, that is equivalent to $2,500 a month in installment debt. So it's basically the same thing as if you already had a $2,500 mortgage. That can present some trouble for people who are just starting out in their career qualifying for a regular mortgage. So this loan product, it basically disregards that debt. The other thing that it does, which is like a nice little benefit, is that you can put 10 to 5% down. Most of these have a 5% down payment requirement, and there's no private mortgage insurance, which can be somewhat costly for regular 30-year fixed conventional or FHA loan. The mortgage insurance can be pretty expensive, so that is waived for these professional loans. What they are not designed for, right? They are not discounted typically. You're not, if you're applying for a professional loan, it is not something that is going to be cheaper for you as an individual. You're not going to get really much of a better interest rate than what you would get on a conventional loan. The benefit is being able to qualify with your huge student loan balance and probably a lower salary than what you will make in the future. So you'll be able to get into that house, and you don't have to come up with a lot of money up front to avoid paying that PMI. I know that's a big stickler for people. They want to put the 20% down because 20% down, you get to avoid having private mortgage insurance. It could be as little as $70, $60 a month. It could be $300 a month that you're just basically paying out the door because you're putting less than 20% down. So this program waives that PMI requirement for people who meet this qualifying criteria of being in these professions. So it's not a discounted loan program. I know a lot of physicians have contacted me in the past and I say, hey, what's the deal with this physician loan? And they expect that the interest rate is going to be lower. And then I explain, to them, some of these people actually were later on in their careers where this loan program actually didn't make any sense for them to do because they were putting 30-40% down. They made $300,000-$400,000 a year. They weren't the candidate for something like this. This is really more geared towards somebody who is just leaving residency. They got a bunch of student loan debt. They want to get into a place and they know they're going to be able to make the payments because they're going to be getting a raise, promotions, and 6 months to a year. Later on down the road, like once they start making payments on their student loans, they're going to be making a lot more money. That is who this program is geared towards. It is not towards the physician who has been established and practicing for 15 years, and has a boatload of cash and a huge salary. Like this is not what that is for. it's for somebody who is newer, and just basically needs a little bit help getting started.